All right, welcome. I'm your quant expert.
And I'm the novice investor. Today, we're jumping into a concept that just feels like it has to be wrong, one that seems to break all the fundamental rules of investing. The idea that you can systematically beat the market.
Yeah, exactly. It flies directly in the face of what we're all taught about efficient markets. And yet, the data shows it's been around for decades. So the big question is this thing for real, or is it just some kind of statistical ghost? Let's dig in.
Okay, so let's just park it right there for a second. My finance professor, every single textbook I ever read, they all just drilled one thing into my head. You can't beat the market. It's a random walk. So, were they all wrong?
Well, for the most part, they're absolutely right. The market is incredibly, ruthlessly efficient. But if you put the data under a microscope, something really weird pops out. There's this persistent glitch in the system, a ghost in the machine, if you will, that's been there for decades. And it's an anomaly that quants have studied, argued about, and even built entire funds to try and capture.
And here's the kicker. The strategy people use to exploit this anomaly, it's almost shockingly simple. It's called the momentum strategy. And really, the recipe couldn't be more straightforward.
Okay, so the classic version, the one you'd read about in academic papers, has just 4 steps. First, you take a whole universe of stocks and you simply rank them by how they've performed over the last, say, 6 to 12 months. Step 2, you chop that ranked list into 10 equal groups. We call them decils. Then, for step 3, you just buy the best performing group, that top 10%, the winners. And finally, step 4, you short sell the worst performing group, the bottom 10%, the losers. And short selling is really just a way of betting that those stocks are going to keep going down. You just repeat that process every month, and that's it. That's the whole engine.
Wait, hold on a second. That's it? You just buy what's been going up and bet against what's been going down? I mean, we're always told to buy low, sell high. This feels like the complete opposite of that advice. There's no way something that simple actually works, right? Not in the real world.
I know, right? The simplicity is exactly what makes it so hard to believe. It feels like it shouldn't work. It feels like a trap. But that's where the numbers come in. And believe me, the numbers are what made this so famous. So let's look at the evidence that basically blew the doors off the academic finance world.
So this whole thing really exploded into the mainstream with this landmark paper in 1993 by Jegadeesh and Titman. And you have to put yourself back in that time. The efficient market hypothesis was basically gospel. The idea that you couldn't beat the market was just accepted fact. So when they came out and said, and I'm quoting here, that these simple strategies generate significant positive returns, I mean, that was an absolute bombshell.
Okay, but significant is one of those academic words that can mean anything. How significant are we really talking about here? How's this for significant? Over the 25 years they studied, this strategy produced an average excess return of about 1% per month. Whoa! Per month? Not per year? That's what, over 12% a year, not even counting compounding? That's an absolutely insane edge.
Exactly. It's a huge number. And this table breaks down exactly where it comes from. You can see the winner's portfolio, the stocks that were already doing well, kept on climbing, up an average of 1.74% a month. Now the losers also went up on average, but not nearly as much. The magic is in the spread between them. That difference is where the profit comes from. We're talking almost a full % of pure alpha every single month. And remember, alpha is the holy grail. It's the return you get that can't be explained by just taking on more market risk.
Okay, my mind is officially blown. But like 2 huge questions immediately jump out at me. First, is this some kind of free lunch? I mean, there's got to be a catch, right? Some massive hidden risk I'm not seeing. And second, this paper came out in 1993. That's decades ago. The secret's out. Surely this can't still be working, can it?
Both fantastic questions. So let's tackle that second one first. Did it just go away? Well, take a look at this chart. This is the killer evidence. That first bar, that's the profit from their original study period. But the second bar, that's what happened in the years right after their data ended. And look at that. The effect was just as strong. The glitch didn't just vanish into thin air once it was discovered.
And that brings us right back to your first question. It's really the billion-dollar question here. Why does this even exist? Is it because you're being paid to take on some kind of horrifying hidden risk? Or is this whole thing just a reflection of our own human psychology? Our greed and our fear playing out in the market?
So really, the debate comes down to 2 big camps. On one side, you have the risk-based explanation. This camp says, hey, no free lunch here. They argue momentum stocks are just flat out riskier. They're crowded trades, everyone's in them. And when panic hits, they get absolutely annihilated. So that extra return you get, it's just combat pay for being willing to hold a ticking time bomb.
Okay, that I can wrap my head around. More risk, more reward. Makes sense. So what's the other side of the argument?
The other side is the behavioral view. And this one says the flaw isn't in the stocks, it's in us. It's about psychology. The theory goes that we first underreact to news, which allows these trends to get started. But then, once everyone catches on, we overreact, piling in and pushing prices way past what they're actually worth, creating these mini bubbles that are destined to pop.
So let's put that risk theory to the test. The most basic way we measure risk is something called beta. If the risk story were true, you'd expect this whole strategy to have a really high beta, meaning it's super risky. But when you look at the actual data from the study, you see something totally bizarre. The portfolio of losers actually had a higher beta than the winners, which means the strategy of buying the winners and shorting the losers had a slightly negative beta. So that simple, you're just getting paid for more risk idea, the data just doesn't back it up.
Okay, so now let's look at the evidence for the behavioral story. And this is where it gets really compelling. This timeline shows the life cycle of the average momentum trade. For the first year or so, it works like a charm. Profits just keep accumulating. But then, it starts to level off. The effect fades. And then, here's the wild part. In the years that follow, the whole thing goes into reverse. Those old winners start to lag, and the old losers start to rally. By the end of 5 years, almost all the initial profit is gone, wiped out. This pattern of long-term reversal is a perfect fit for that behavioral theory of overreaction, followed by a painful correction.
Whoa, okay. So this is definitely not a buy and hold forever kind of strategy. It's more like surfing. You've got this perfect wave for about a year, but you absolutely have to get off before it crashes. Because if you stay on too long, the edge doesn't just disappear. It actually turns against you and wipes you out.
That is the perfect analogy. Discipline is everything. You have to know when to get off the wave. So, knowing all this, how can we actually use this information? Let's distill this down into a playbook for how someone might think about this today.
Okay, 3 big takeaways. First, don't put all your eggs in the momentum basket. It turns out momentum is what we call negatively correlated to value investing, which is all about buying cheap, boring stocks. That's a fancy way of saying they often move in opposite directions. So when momentum strategies are getting crushed, value is often doing just fine, and vice versa. If you combine them, you can get a much, much smoother ride. Second, and you really have to hear this, beware the crash. Momentum has a dark side. When it blows up spectacularly. I mean, in a single month back in 1932, the strategy lost 40%. 40! So you have to be prepared for these violent, sudden reversals. And finally, always remember why it can be so dangerous. It's all about crowded trades. When everyone is on the same side of the boat and something spooks them, they all run for the exit at the same time. And when that happens, liquidity just vanishes, and the losses can be staggering.
So it's clear this isn't just some weird fluke from back in the day. It seems like it's a real persistent feature of how markets work. It's basically the engine inside a lot of those momentum ETFs you see everywhere now, right?
That's exactly right. And that really brings us to the final, fascinating question we have to ask ourselves. Is this momentum anomaly a permanent edge, something that's just baked into our unchanging human psychology and will always be there? Or is it just a temporary glitch that eventually, as more and more people try to exploit it, will get smoothed out and disappear forever? The data, for now, suggests it's sticking around. But if there's one thing we know for sure about the markets, it's that nothing is guaranteed.